Well, hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. We are really excited to share with you our Zoom video call. For those who are here live, and I see we've got quite a few people here live, clients and friends and family that are in. We appreciate it. Thank you for taking the time and scheduling. If you find this to be of value and a benefit, you can't listen to the whole thing today, or you want to hear it again, or even share it, we ask you to go to reach out to Diane. You could always do that if you have that email link as well, and she'll get you the PDF copy as well as the audio follow-up on this and YouTube link once we conclude today's mid-year outlook. But again, thank you for watching. This is our mid-year 2020 outlook, and for Blanke Schein Wealth Management, our entire team here, and our clients, this has been one heck of a year. There's no question about it. Completely unique, unpredictable, and we're halfway through. So our goal here today is to walk our clients through our thought process, and what we see for the next, 6 months, if you will, the both short and long term as it relates to markets and our investments. Blanke Schein Wealth Management, we take our job extremely seriously. We're working overtime. And we always are. We love the markets. We love our interaction with our clients, and we're missing all of you. So we hope that you're staying healthy and staying safe. And we hope to see you again. Our offices, just so you know, are closed, and they remain closed, obviously per governor orders here. But we're here working every day. I haven't missed all but a handful of days in the office personally, and our whole team is safe and working remotely as well to support everything we need to do. And what we've learned is our business functions flawlessly. We're a great team. We've got great team members here, and we're all connected. And I think the technology has really sort of shined through this whole process for all of us to be able to do our jobs and do that extremely effectively to serve every single one of our clients over and above. We've been overwhelmed with a lot of new accounts and a lot of new relationships, so we appreciate that as well. So let's get right into our presentation that we prepared for you today. And let me go here. There we go. So Blanke Schein Wealth Management mid-year 2020 mid-year outlook. And we're going to start off with the questions that you've asked. In our monthly and quarterly calls with our clients, we oftentimes hear a lot of the same calls or field a lot of the same questions on those calls. And what we want to do is to hopefully have this opportunity to answer those calls or questions on those calls that we've heard. So the questions we're going to go through today, and hopefully we answer them in terms of sort of the arc of this conversation. It's going to be a little bit less than an hour. I'm going to try to do my best. We've got a lot of slides for us today. We have 35 slides to get through, and I'll do my best to be concise, consistent, and to the point, but at least get the necessary information that's out there. Question one is we're going to go through is what's the shape of the recovery? What will it take? And we'll talk about that. The question is how and why are markets up? And, the markets continue even today as we record this video. Markets are up and continuing to, actually get to, up on many, many levels year to date. It's incredible. We'll talk about that. And then what to expect in the second quarter earnings report for 2020. We got a lot of this. The next question is about real estate, and I'm going to touch about real estate and talk about maybe is there a potential for foreclosures and the threat to the real estate market going forward. We're also going to discuss the 2020 presidential election and the impact on portfolios and how do we position accordingly. I just want to let you know that we're going to also have a follow-up call, most likely in August, that's going to focus solely on this. So we will spend a lot more time if we don't spend too much time on it today as we grow closer to November, and we're going to continue to give you more feedback on that in terms of our portfolios, our thoughts, and the positioning as it relates to that. And then finally, what are the catalysts that could trigger a market sell-off? Again, as I said, we've come far too, there's a lot of just enthusiasm in the market, and the question is, and we'll discover that today, is it actually justified? And obviously at the end, we're going to have our 90-day what to watch. So I put 5 things down that we're watching here at Blanke Schein Wealth Management as it relates to we manage our clients' portfolios that we think that you should be watching as it relates to that. Another thing that through this pandemic, everyone sort of has to make their shift in their own business. And we've shifted a business model direct to you. Obviously we can't see you, but we went directly to YouTube. Diane and her wonderful thought process came to me and says, hey, we have to, reach out to our clients and keep them informed. And I couldn't agree more. I just didn't have the technological wherewithal, but thank God I have, Nayan right here with me and our team that surrounded us. So long story short, if you were with me on our early podcasts or videos and YouTube videos, we thank you, because that was a little clunky and we learned on the job, as I think we're all learning this new dynamic that we're in. But more importantly, we're receiving tremendous feedback. In fact, here are the analytics. And if you're not subscribed, we ask you to go to the YouTube channel after this and subscribe, because then you'll get it automatically instead of it just sending us out a daily email, as Diane has done for all of our clients. But since January, check out these analytics that we see on the inside. We've had over 19,000 views of our videos, and we've had a total watch hours. We've had over 668 hours of watch time. So people are watching, and what we have is we have over 50% of our clientele, or at least households, that are tuning in on a regular basis. So we really appreciate that. And the whole purpose here is to provide you with relevant, real-time, market-related information. This news cycle that we have is sort of upside down and crazy every single day. And in our household, the Schein household, we seem to turn it off in the afternoons. So because I don't want my kids exposed to what's going on, and unfortunately, because a majority of what we're seeing is opinion television, and on both sides. And I also want to let you know that this presentation is not going to be political. It's not aimed to be political. It's just to report the facts that we see that what the markets are paying attention to. And of course, they come off as political, but more importantly, at the end of the day, the markets are paying attention to a few things that matter, and we hope to report that to you, however you guys want to take it. But again, our goal here is just to bring it to you as we do our morning research on a daily basis. And so Nayan has... Let me grab this, Nan. Okay, let me talk about the Hightower story real quick for those who are new to us. Hightower, the map here shows our Hightower office presence across the United States. We have 105 advisory firms and 85 offices nationwide. We're operating in 33 states, and we have 50 billion assets under management as a team, or excuse me, as a firm collectively. And as our team here, and we're in Palm Desert, California. So we have a Hightower partnership and a Hightower network, collective wisdom, as we call it, to share best practices and also daily research. And I'll get into the research resources that we have as well. Here at Hightower, our partners are accredited investment fiduciaries. All our advisors here on our team are. There's an extreme nuance as it relates to that. It's the fiduciary standard, which puts the client in the middle versus suitability. Suitability is, if it's the old world of doing business on Wall Street, you want to find an advisor that is accredited investment fiduciary. Ultimately, that's legally obligated to do what's your best interest, financially speaking, at all times. And that's what we do here at Blanke Schein Wealth Management, because we have that oath. This is our benefits. We don't want to spend too much time on that, but Blanke Schein Wealth Management takes a long-term approach to how we think about capital markets, how we invest our clients' hard-earned dollars and retirement dollars. Last 25 years of my career, if you will, I've seen the market, drop by 50% over 3 times. And we've been able to meet and exceed client needs in terms of cash flow and managing that. And essentially that's because it's a result of our investment process, which is disciplined, obviously dispassionate about sort of what we see out there, just real-time related facts as relates to our clients' portfolios and how we need to position properly. And we're patient. We're long-term views. The equity markets theoretically is a long-term asset class. And so it should be considered as such. Our disclaimer, that's for all of our attorneys that at Hightower to make this happen, and we thank them for that, for this presentation today. So let's get right into the access and choice. One of the reasons why Hightower, we have some real-time relevant information for our clients is we have access to the street research, as well as investment resources. So everything you see here and more, we have access to on a daily basis. And on my updates for my clients, we're looking at qualitative resource, policy research, technical strategy, economic research, our daily micro briefs, what traders are watching. We get I got a daily update, what traders are watching from Jones Trading every morning. And it's essentially, if you watch CNBC, it's what Art Cashin is basically repeating and reporting on. So we get up at 4:30. I get up at 4:30 every morning, and I know Rick Jr. as well, and Rick Sr. And we as a team have our team here has over 100 years plus collective experience, and that's our Blanke Schein Wealth Management Investment Committee. We have Don Stockhausen, Mike Shields. We also have an associate, Corbin, who just came to us from UCLA, recent grad. And he's also doing a lot of research for this. And so we appreciate that. We put that together in our Tuesday mornings briefings as a team in our investment committee. And we take all of this collective wisdom, as well as this is what we get on a daily basis. And these are all the street resources. And so you can't just have one person on the team go through that. You have to have the team approach to get best minds, sort of wisdom, experience, and sort of direction as it relates to investing our clients' hard-earned dollars, and that's what we do. So these are who we have access to, and that's just not limited to, but we have over 50 plus research access to the street, what they offer as well. So it's wonderful. Custodians, our clients are with Schwab and Fidelity. Those are accolades. We can skip this. And here, let's go to the burning questions. 5-step comprehensive wealth management process. What's really successful for our clients here at Blanke Schein Wealth Management is our process. We can't say that word enough, and it really means really keeping our clients engaged. We start every client with a financial plan, and that financial plan dictates their investment policy statement, if you will. So the risk tolerance. Every client is unique. And every client has a unique story to tell, financially speaking. So we start with that story. We engage with the family. We engage with their wants and needs. And we also look at these 5 burning questions that when people come to us in the middle of this is really the lifestyle. They want the worry-free lifestyle. They want travel and education and sort of their careers or businesses to be sort of well looked after so they can have sort of a peaceful mind as it relates to working with us. And that's what we have hope to provide on a daily basis when we engage with our clients. But what clients are really looking at is the income it provides, both current while you're working, but long-term in the future. Will that income be lasting? Will it stay paced ahead of inflation over time? And will it grow over time? And that's what we really look at our investment resources, marry that with a plan to provide that cash flow that is durable, consistent, and it grows over time. Because we all know that as we get older, our expenses ultimately, from healthcare to food, everything else, it increases. There's inflation, regardless of how the government reports the CPI, which is an inflation reported government index. We also talk about legacy planning. So we talk about the estate planning. And, with the coronavirus, it's really sped up a lot of conversations in everyone's households. Estate planning. We have great estate planning attorneys that we work with. We're happy to make some recommendations. If you need your estate plan looked at or updated, especially wills, trusts, advanced medical directives, medical power of attorney, so on and so forth. So we encourage every one of our clients, this is the year, if you haven't done it, to make that happen sooner or later. We've got great resources for you here to make a recommendation. Also, the investments, as well as healthcare in those categories as well, we take a look at all of that. So that's a little bit about what we do here. We put that into what we call your retirement dashboard, so TR360, and it's a simplified approach to your income statement, your net worth statement, consolidated one page, if you will, as well as this is proprietary to us, your future. We call it retirement income intelligence, and it's a projection in the future of cash flows, and we take into consideration taxation and legacy planning and what pocket we take it out of to fund that vacation that we're going to take next year. And yes, we're going to return. We're going to get to vacations hopefully sooner than later. There was some good reporting from the biopharmaceutical companies today, getting closer to vaccines. So that's important too. Let's skip ahead. One of the questions today is, as of July 20th, this is from JP Morgan. It just shows the indices. So the S&P 500 is in yellow, and the year-to-date return, which was as of this last Friday, was flat. Right now, I think it's up year-to-date. We look at the NASDAQ, and remember, the NASDAQ is technology, okay? So it's technology-driven. That's up 18.9, even more so since this last Friday's close, as is reported. So it's close to 20% on the NASDAQ year-to-date. And then the fixed income I highlighted, all of those are up. So fixed income, if you remember, your bonds go up in value as if you own them, as interest rates drop. And we just know that the Federal Reserve dropped interest rates to zero, close to zero, as we went through this pandemic. And then down here, style of returns. So let's go to the S&P 500 sector of returns. If I can move my mouse, I'll show you right here. Technology is leading the way. If you look at the S&P 500, okay, so we talk about the S&P 500, Standard & Poor's 500, and you take each company that's listed inside the S&P 500, and you put them into a sector. So there used to be 10, now there are 11 sectors. They carved out real estate this last year. So there's 11 sectors now of the S&P 500. Together, if you put them together, the S&P year-to-date is flat. If you look at them individually, sector-wise, what we have are sector returns. Again, as of, this is July 13th reporting. Technology, again, is up 18%. Consumer discretionary is up 14.8%, and so on and so forth. Healthcare is flat for the year. Energy to the far right-hand side and financials and industrials are all lagging. We saw energy take a big hit as we saw, earlier in this year. And so energy is down still 40%, 39%. And then financials in the banking sector down 22%. So if you put them all together, you're flat for the year. If you're overweight sort of some styles or some sectors, which we tend to do when we manage portfolios, you're outperforming markets. And that's how we do that at Blanke Schein Wealth Management. You look at not all, you can own the S&P 500 if you want to, but if you really want to sort of overweight some, or, take the portfolio, overweight some sectors that are outperforming, that's how you get that outperformance. So let's take a look at this right here. This is from our investment committee. We update this all the time. And Blanke Schein Wealth Management, this is our dashboard. And there's four key, we call it the four horsemen. There's four key fundamentals as it relates to what we see really matter to the markets, foundationally speaking, structurally speaking. And number one is fundamentals. Are the fundamentals from the GDP or the United States, financially speaking, solid from earnings and so on and so forth? We'll talk about that. Technical analysis. Yes, I've brought this up several times in sort of the reporting that I've done, that we do a lot of technical reporting. I'm sorry, it's a coffee stain because I constantly have this on my desk and stuff happens. But this is a technical chart that shows support levels of the S&P 500. And that's very important because it tells us whether or not we are going to retest market lows. So structurally speaking, markets put in bottoms, they retest bottoms, but they don't have to go all the way back to where they were. And the technicals tell us that. So as long as we're in a trading range, as I've reported before on my YouTube videos, and I constantly talk about the technicals, those are important. That's a bullish sign right now. In fact, the S&P crossed over 3,200. We could be there right now today again. So that's an important technical. It's a bullish category right now. Sentiment is another key component that we take a look at. It's the investor sentiment. We put that in the neutral category right now. But Small Business Association just reported yesterday that there's positive 2 months in a row sentiment going into or going forward. Obviously, when we had a government mandated shutdown across the United States for small business owners, that was a real big sort of blow to the United States, economically speaking, especially small business owners. But on a go-forward basis, the sentiment, especially on the small businesses, is positive. Now, there's some reopening stories and nuances that could sort of stall that. That's why we don't put it in the bullish category. We put it in the neutral category right now. And then the biggest component here is the fiscal and monetary policy. And I've brought this to the forefront in just about every other video update that I do on a daily basis. Keep your eye on the fiscal and monetary policy response. In this case, they have been extremely rapid, and they used, Fed Reserve came out when they used the bazooka. They used 10 times more than they needed in terms of what they stated they would do, and they haven't even used a fraction of that in many capacity and cases. The key is the rapid response, and I'll get to that. But here's the sort of the layout here. Fundamentals, I'll get back to this, is the GDP. Now we know that the GDP is going to be, the all-time historic low potentially for the second quarter reporting. And we're talking about the third quarter snapback GDP and what the reopening may or may not do to that. But fundamentals is really a key component of the four horsemen that our investment committee at Blanke Schein Wealth Management look at. But right now, we don't see any red on the screen. So we're in a good standing right now. And there's been times where it's been one of the categories has been red. But as of right now, we're in a good spot. Let's see if I can go to the next page here. this is a question: is what shape will the recovery take? If you're following the markets or you're following, some of the experts on all the business channels, you hear all of these. What is it going to look like? And you hear alphabet soup. Is it a V shape, a U shape, a W? I put that here so we can visually see this. And what economists are referring to is essentially the GDP, i.e., or the economy itself. Not so much the stock market, but the economy itself, okay? And as it relates to our GDP, gross domestic product. And here are all the estimates. Here's what a V shape, a U shape, and a W shape look like. The stock market believes in a V shape, as we've seen recently. I early on talked about the Nike swoosh. I'm on one of my YouTube videos early on with our empirical evidence. I think even we've got First Trust and Brian Westbury and his team that have been spot on all this real-time market-related relevant information that we use and rely upon here at Blanke Schein Wealth Management. And they agree as well in terms of the Nike swoosh, in terms of the economy. So it's not a V, which is a 100% snapback on the GDP. It's going to take some time, and we'll talk about that. But we think the U shape, maybe a pullback a little bit, economically speaking, is possible. But a W is not. We don't see that in the cards, and there's several factors as it relates to that. Let me go to the next slide here. Let's talk about the bull case, then we're going to get to the bear case, and this is by our friends at Strategis. They talk about the Federal Reserve. The Fed is aggressively easing the M2 money supply. I've talked about this many times in my daily updates, and we're going to address that. How and why do we believe the markets are up, or how is that even possible? We're going to talk about that. And another thing is the fiscal stimulus is more likely. The market's already anticipating that there's going to be another round of fiscal stimulus. Congress has July 20th is when they come back. They have until the end of the month, if you will, because that's when a lot of the additional government $600 monthly checks go away for unemployment enhanced benefits. So they have to act soon. There's another round of small business assistance that's going to be sort of measured and direct, potentially. That's another thing that's going to be discussed. There's also liability protection for small business owners that's going to be discussed. So that has to be all worked out, and they have 10 days to do it once they come back July 20th. Nancy Pelosi, as I reported yesterday, said that they're going to stay extra in overtime, which is wonderful. I'd love to see that because that's what they should be doing. They shouldn't be on recess, to be honest with you. This is a crisis. We're all working super hard, in fact, doubly hard as it relates to this. So everyone needs to, all of Congress needs to get together, and markets are looking at that. It's not if, it's when that there's going to be another round of stimulus. It's going to be priced in. So the question is the size. It's sort of the concern going forward. The momentum the last 3 weeks that we've seen has been impressive. It's been narrow, and we've seen S&P in a trading range, but we want to see that broaden out. Today we're seeing that. So the laggards, as I've discussed, are the banks, if you will, or financials as a sector within the S&P 500. So we're seeing money rotate into that because technology has taken off. And I've used this analogy once before. It's, we have 4 kids in the Schein household, and they're all teenagers. And my wife and I like to hike. And so if we were to hike up the mountain, here locally, it's called the bump and grind. And, the little ones usually, run ahead. And I'm the last one up the mountain. And as we get up the mountain, to use this analogy, for you guys to understand sort of the indices within the S&P 500, or what we need to see is a market rotation or broadening out, is for us to move higher in the markets, we need to see some consolidation. So we see money coming out of technology going into the energy and the financials and the utility, the industrials, if you will. We're seeing that today. We need more than one day. We need, sort of a couple of weeks, or if not a month of consolidation. But to get back to the analogy, I would be the financials, if you will, or the energy sector, and my kids would be the technology sector as it relates to running up a mountain. So the kids always would run up faster than mom and dad, and they'd have to sort of take a stop and a break midway up the mountain for us to get up to them and catch up to them. Because if they go all the way to the top, and mom and dad, or dad specifically in this case, is still lagging behind quite considerably, that's really, the market indices can't go anywhere if you put us all together. And so what we want to see is that consolidation. So it's okay to see technology take a breather to allow and afford for the underperforming sectors of the S&P to catch up. Once we catch up, we all catch our breath. That's called consolidation from a technical standpoint, or a broadening in the marketplace. It's all constructive. It's all positive. So again, from a technical and fundamental factor, we look for these things, and these things are actually playing out in the markets. If not today, they have been over the last few weeks as well. So that's a very positive. TINA is something we use in the financial services industry, is the no investment alternative, if you will. For fiduciaries have no other place to go. A fiduciary, you have an obligation to put money invested. So think pension plans or private equity or money managers, and that's billions and billions of dollars. And so you can't put it in the money market at a local bank, because you're going to get eaten alive by, if not inflation over time, on the short term, you're going to get eaten alive by returns. So this is a prevailing theme on Wall Street. When the 10-year treasury is low, and it's historically trending lower, and it's been lower now, even year to date, you can get, let's call it 70 basis points in your 10-year money if a U.S. Treasury, or you put it in money market alternatives that get higher rates of return, possibly, potentially short-term fixed income, longer dated fixed income securities, higher yielding fixed income securities, all the way down through. You see where this is going, obviously, and then there's always the market, the equity markets. So there's no alternative, and that's where you're seeing all this money built up, which is the empty money supply, 20% year over year, 18% the last 13 weeks. Which is substantial. Give you any indication, we'll talk about that. That's a 2 standard deviation move. And that's a lot of money, and that's what the Federal Reserve and all of these policymakers aim to do. So that money has to go in the public markets and low rates. So that's another case for the bull market. Now, a case for the bear markets, the magnitude of the damage that's been done, in terms of this recession, will take years to repair, and that's quite true. There's been a report that 30%, 31% of small businesses might not reopen. So that's not only small businesses, that's the damage to the retail sector as it relates to those businesses closing up. So that's real estate, commercial real estate specifically. It's also unemployment. So those people will be searching for new positions. And so that's the long-term magnitude of the damage. We're going to have to wait and see on this. This is, this happened sort of the scene of the crime less than 4 months into this right now. But these are long-term damaging effects to the U.S. economy that hopefully weren't going to be as bad as originally reported. But I suspect somewhere from worst-case scenario to mid-case scenarios where we're going to land on that. Valuations. Valuations are hard to predict because it's a PE conversation, so price to earnings. We can't price earnings right now. In fact, the SEC told in the second quarter all corporations that they can throw out the earnings guidance. Traditionally, actually, they encouraged CEOs that they would not be subject to any violations from a reporting standpoint if they provided better guidance. So they encouraged the corporations to provide guidance often and updated as real-time possible. But from Wall Street standpoint, we can't get an indication of what earnings will be. Therefore, no one really knows what the valuations will land at. So when you hear people say, oh, the market's overvalued or the market's undervalued, no one knows the answer to that question. They really don't, because we don't know sort of what the earnings number is, so the price to earnings ratio, so the E of that equation. And that's going to be playing out, and component to that is how we reopen. If we have a faster reopening, earnings expectations, if we have vaccines, our earnings could go real fast. Therefore, the market is significantly undervalued if that's the case. If we have a sort of fits and starts along the way, like California's having, that earnings expectations could come down. So those earnings not be as robust as they need it to be to support current market valuation. So that's what the bear case is that the valuation is an unknown. So time's going to help us on this one. And then the other question is number 3 is fiscal and monetary policy is largely being used to plug holes in the economy. Think about this. The U.S. economy, based upon the GDP, gross domestic product, is $20 trillion, so 18 to 20, coming into this year. In fact, we had a strong economy coming into 2020, and that's one of the saving graces that we have right now is why markets are up. If you were to take quarter by quarter, you're looking at $6 to $7 trillion or even take the 20 trillion divided by 4, and you're looking at 5 trillion. Well, the U.S. fiscal and monetary policy, plugged the hole with stimulus of $7 trillion, and they're asking for another round of stimulus from Congress through the CARES Act 2.0. So that's where the markets are saying, wait a minute, we've got money. And where's that money been? That money went out to the bank accounts direct, that went to the hands of the consumer, and that's reported in the M2 money supply. So we know that the consumer had it, it's in their banks. We know that small businesses had it by way of loans or forgivable loans, and that's in the banks. And that's how we follow the M2 money supply. So the Federal Reserve and fiscal policy knew that the money was there, knew that they had to get the money in the hands of Americans to help small business owners in a short term, but more importantly, plug this hole. So we say 5 trillion on a 3-month period, but they put out over 7 trillion and they're adding more to it. So that's more than a substantial plug to the economy, and that money will work its way back in the system. Now, if they pull back on that, that's bearish. So we will see what Congress does. 5 reasons, I kind of hinted towards this and discussed this, how and why markets are up. The first is rapid policy response. We call this in our industry M&DSNL, Mom and Dad Savings and Loan. The federal government, if you want to go to Hamilton, if you will, he thought that there were stronger, some of the parts is stronger as a whole. So here's where we are. The Fed, really came to the rescue as it relates to being rapid response. I think there's 2 critical things here. The financial markets wouldn't have recovered if we didn't have, as quickly as they had, if we didn't have 2008, 2009. Because that was the revamping of the US banking system. If you recall, back in 2008, 2009, the US banking system literally went out of business, unfortunately. It was government assistance. We all as taxpayers bailed out Wall Street, if you recall that. And those dollars then made it back into sort of propping up the banking system. And then we had the Dodd-Frank Act that basically said, wait a minute, we have to plan for black swan events far into the future. So you guys are gonna have to have excess reserves, like tenfold. And you can't lend out as much as you did because you lent out 10 times what you actually should have in the past. And ultimately, all of that reform set us up for the banking system to be tremendously strong today. So the US banking system is extremely strong. And I firmly believe if we didn't have the crisis before in 2008, 2009, and the reforms, the US would be in a very different spot right now post this crisis. Federal Reserve knew this, and they went right to the banking system, they went right to the consumer, and they basically provided cash injection to both the small businesses as well as the individual payments to people. And then the fiscal response, and oh, by the way, the Federal Reserve is constantly, when they practice, they constantly look at crisis mode. So in a normal year, the Federal Reserve looks at historical monetary policy through the Great Depression, the Industrial Revolution, all the way through the wars, and they've not seen a pandemic before, but they have all these tools in the bag to have a quick, rapid policy response. And really, what I really believe is why we are where we are today is how quickly they acted with Congress and how quickly Congress reacted to get that money in the hands of small businesses as well as the consumer. We saw it in lightning speed. They should be applauded both for this. History will show and tell if they did the right thing. Obviously, there's always going to be policy error here and there, but they made the decision to move quickly versus getting it right. And that was the difference, nuance, and what the historical sort of analogs of the Federal Reserve does when they look at history. They say the Federal Reserve fails when their policy response is like prolonged or isn't quick enough. So it's almost better to give more, quicker, and faster than to get it right and get it perfect and make sure that this person doesn't get a double payment or that person gets what they're fairly entitled to. I think they got it right. Unfortunately, it wasn't perfect. And they made some policy corrections, especially on the PPE, all along the way. And they were rapid in doing that. So that was good. Number 2 is size matters. So I brought this up in my daily updates. Size matters. So think about this. There's public and private markets, okay? The NASDAQ, S&P 500, Dow Jones, all the markets, even beyond that, if you take the publicly listed traded companies right now, you have 4,397 publicly traded companies, okay, versus 30 million small businesses in America today. So we have less than 5,000 publicly traded companies versus 30 million small businesses in the United States today. What does that mean? In the midst of the pandemic, the financial markets did their job by way of providing liquidity and financial access to the publicly traded, the largest companies, the strongest companies. There's some weak sisters in there for sure in the S&P 500, as well as all the publicly traded institutions that we're seeing the indices. But those companies had real-time access to capital, and Wall Street provided that capital in a real-time basis. Think about bond issuance. If you look at the bond issuance year to date, this is the greatest year historically speaking. So we're surpassing any other bond year in terms of issuance on a corporate bond side. That's significant. So that means that these corporations had the ability to access the capital markets, sell equity if they wanted to, provide bond offerings if they needed to, create that additional capital. Think the airlines plus an additional line from the government to keep them afloat. But all of them had access to the credit markets, unlike the 30 million. Okay, and I go back to the Federal Reserve's policy response, which means they knew that the small businesses, which are the backbone of the United States, needed a gap stop, or stopgap, if you will, money to get them through so they can live as they're shutting their barber shops down, their nail shops down, and their gyms down. Now, what you get through every economic recession, and yes, we've had a recession, is you will have businesses that fail. Recessions ultimately sort of are that cleansing and purging of businesses or business models or mismanaged companies, or businesses that were just one check away, if you will, from not being able to be open, not only a year from now, let alone a month from now. It exposes your weakness. So if you're not a well-run, well-capitalized, well-established business, and then you got hit by the pandemic or you got shut down, you're going to need some short-term assistance, right? There was one report that said most small businesses in America had less than 2 months in their checking accounts to basically be able to keep open. And again, that's what the Federal Reserve came in with the Small Business Association relief or response. It could be a forgivable loan, and or it could be a loan as well from a disaster relief program. So that's not the saving silver bullet. There's going to be a lot of pain going forward, and the 30 million is the thing to keep an eye on. But the 5,000, if you will, they're publicly traded, they're going to live another day. Let me give you an example. They just had the perfect storm. Think big box stores. We're not allowed to sort of give individual company names out because that could be seen as a recommendation. But think about the stores that were allowed to, wholesale warehouse discounters that were allowed to remain open. There was long lines out there for toilet paper and a few other things, or even the discount retailers that have big box stores that were allowed to remain open. And they sell everything at a low price, right? And everyone loves them because they're so cheap, everyone can get a good discount there. Those two institutions that had the ability to stay open are publicly traded. So they have access to the credit markets. They have access to the equity markets if they needed to raise some capital. But more importantly, what the governments just did, and this is not a political statement, this is what just happened, is they sort of pick and chose winners and losers. Meaning if the mom and pop shop was the local store trying to stay open and compete in good markets and times, and you can't compete with those big stores. But they were forced to shut down. They were forced to close with no question of how they can get their next sort of sale to pay their rent, to pay their employees, to put food on their tables. So if you're a publicly traded market, you just had, or a publicly traded company that is government assisted ability to do business, you just had the perfect opportunity for the government to take out all your competition. So the markets look through and see this. That's why markets are up. That's why some of these companies are up, because it's not talking about, 6 months from now. They're looking at 3, 5, and 10 years from now. Structurally, a lot of things have changed. And so unfortunately, winners have been chosen and capital markets have rescued them. So size does matter. So the equity markets are different. And that's why you're getting a disconnect from Wall Street and S&P 500 or NASDAQ and a lot of these versus the economy and the real economy. And that's a big thing. Technological revolution, we're seeing these trends accelerate. Kids from staying at home and learning on the computer. You're seeing a lot of these companies, like chip manufacturers and a lot of sectors in technology, take off. There's a boom there because everyone now needs to adopt technology, learn to do this right now. And thank you for watching. So that's another reason why markets are up. And then the last two are FOMO and TINA. TINA is there is no other alternative for private money managers or fiduciaries that have really managed money on a size and scope to put money to work. So as the 10-year treasury stays low, the higher rates of return are out there in terms of the risk markets to place sort of market to work there, as well as FOMO, fear of missing out. We're seeing a lot of sort of markets run up. And so that's concerning, but that's another reason why the markets are there. I'm not going to spend too much time about this because I talked about this, the Federal Reserve's balance sheet. And this is a historical look at the US balance sheet from the Federal Reserve. It's reached $7 trillion. In the short term, that's not a concern. Long term, for my kids and great grandkids, structurally speaking, that's a concern. This is a slide that discusses basically how the Federal Reserve has changed the complexity, what they have done as it relates to the assets that they have purchased. So they announced early on that they're going to go into the open market and provide a backstop of liquidity in money markets, in investment grade corporate bonds, in high yield bonds. They've never done that before. And this is the composition of their balance sheet. Mortgage-backed securities. They even purchase mortgage-backed securities. And the reason why they did that is to provide the interest rate market and the real estate market and the lending markets very specifically to stay open. Real estate's been strong. It's going to continue to be strong going forward. And they wanted to make sure that that credit market doesn't seize up for the lending capacity. In fact, if you look at the real estate numbers, they're significant. So the Federal Reserve did that. And this is empirical evidence as to what the market looked at as to why it's really important. Clients are calling me saying, you know, I'm worried about this, I'm worried about that. And I'm like, no. The Federal Reserve did the right things at the right time, and they did it sooner than they should. Or at least they did just in time as they should have, and the market saw that, and that's why markets continue to go up. And this is empirical evidence of what they did and why they did it. It's a lot of economics, and I'm sorry to give you sort of the economic blueprint behind the scenes, but this is what the markets pay attention to, what matters. Fiscal policy, essentially 82% up of the M2 money supply, is positively correlated with the S&P 500. It's a 2 standard deviation move. And what's good here is that the S&P continues to rise as it relates to the M2 money supply comes down. Again, all this means is the Federal Reserve and monetary policy and fiscal policy, so Congress and the Federal Reserve, gave money to enhance the small businesses, individuals, as well as corporations. And that money is in the bank accounts. So one of the greatest economists that I follow, Dr. David Kelly of JP Morgan, he gives quality updates, and he's from England. He's a European approach if you were looking at Americans. And one of the greatest lines he ever said 20 years ago is, you know, America is driven by is a consumption economy. 2/3 of our economy is driven by U.S. Consumers consuming. He goes, that'll never change. We're a consumer-driven economy. So one thing he said is, if you give an American $1 directly, that's going to go tenfold in the economy, and it's not going to stay in the bank. It's going to be spent in the economy because Americans, unfortunately, as he put it, aren't disciplined. They don't save for tomorrow. They get $1 in the bank account and they spend it. And again, that's our US GDP. That's our economy that makes it grow and go. And so what the Federal Reserve did and what the Congress did is they went directly to giving money to the consumer, and they knew immediately as that stopgap would be, they would spend it. Now, there are a lot of online activity that we're seeing from retail America. But you got 159 million electronic payments, or $267 billion that was sent out. So $300 billion, that's going right to, you're seeing the M2 money supply come down. That's going into the economy. So we're going to have a third quarter that's going to be huge on the GDP bounce back. Jobs. This is all about the economy. So this is basically a jobs story. And the question is, the real concern is, we know that there's going to be incentives to go back to work. We know that the disincentive is right now the $600 government additional incentive per week to stay home. Small business owners have rights, if you will. I was on a great call from one of the local attorneys, and they had a labor attorney on that said, if a small business owner calls that employee back and provides a reasonable offer to return to work, and the employee says no to that offer, meaning that they might be making more staying home versus going back to work, then the employer notifies the unemployment office, and then that person gets taken off the unemployment insurance. So who knows if that's going to actually fall through or take note, but that's sort of the give and take cat and mouse game behind the scenes, because employees or employers need their employees to come back to work for all of us as we reopen the economy. As we know, 30 million Americans or small businesses is the backbone. And 64%, this is an interesting statistic, 64% of all jobs created last year were from small businesses. So that's the key to watch going forward on this reopening story. The markets are watching the peak initial claims initially, and then they went to continuing claims. So as peak claims peaked, the markets went to continuing claims. The media will choose initial claims or continuing claims, whatever they want to report, which is the worst of two numbers. The best part is both of those are trending down. So the initial claims, the continuing claims, they're coming down. Now, what the market also looks at, this is an overlay of the S&P 500 in orange, as the yellow is indicating US jobless claims are coming down. So there's sort of a correlation there, inversely related. Markets go up while employment sort of claims go down. But here's what's interesting is unemployment from 2008, 2009, it took 5 years to return to the pre-recession period from 2008, 2009, for unemployment to return to normal. And if we go back to 2001, 2002, it took even longer than that. So ultimately what's happening is we're not going to get the employment numbers that we had before. I'm hearing stories of a lot of companies shedding, unfortunately, this will never be reported in the media, but they're shedding older Americans because they're using a pandemic to do so, which means higher wage earners in corporations, and they're bringing in next generation, if you will. Unfortunately, this is one of the reasons why markets are up, because this is the greatest non-HR claim in history, because you can bring in 2 for 1 on a go-forward basis, and you won't be in the world of discrimination. We always worried about that growing up. My dad worked for a big industrial company, and every day on the kitchen table, it was always about layoffs. And as he get closer to retirement, my mom was worried about my dad being laid off before his true realized retirement date, because there was always recessions growing up, in the 80s and 90s, if you will. And so I just know that that's the dirty little secret that's happening right now. So companies are getting leaner and meaner. They're bringing in, if they're going to spend that money again, they're going to do it on new technologies that they have to anyway. So again, that's another reason why the markets are up. So the labor numbers, unemployment, are still going to be stubbornly higher. You wait and see, and you watch how this plays out. But the markets know this, and markets can go up even though unemployment stays stubbornly high. What to expect for second quarter earnings? Nayan's telling me we're a little, we got to continue on time here. The take home point here is that the second quarter earnings are, we really got to go. It's a throw-out quarter right now, simply because there's no guidance, but the third quarter is the most important. Your home value, foreclosures and real estate. Your home, this is important, that is from the Federal Housing Agency. 62% of the first lien mortgages are federally backed. So if we were to see a foreclosure wave, we've got a lot of federal assistance out there as it relates to these from Fannie and Freddie and housing. And we want to look to the bank earnings this week to see sort of what the forbearance, or those that are obviously asking for assistance to pay their mortgages. This is going to take time, and we'll see how this plays out. But I think we're in a good spot with real estate. This is what we can expect in the next 90 days of the market. As historically, speaking, and these are observations versus a presidential election. This is the S&P 500. We've marked in the red box. We're about here as you approach the back half of the year. July is seasonally comes out sort of a consolidation mode. So on the bottom axis, we have sort of 0 would be January 1st, and to the right is all the trading days going forward on the bottom axis. And we're right in the middle of the mid-year. And you can see, so if you have presidential elections, you can see a little bit more volatility, or just a flat consolidation if it's non. We add in all the observations of how the S&P performs from July, so July, August, September. So those sort of third quarter, if you will. So consolidation going forward on the markets is not a historically normal, but some volatility picking up because it's a presidential cycle is probably something we will see as well. This is something I know a lot of clients have asked about. How will the 2020 presidential election impact the markets? This is if it really breaks down, this great work by strategists, partisan control. So this shows the average annual performance of the S&P 500 when you have, let me teach you sort of how to read this. And these are taking out 2001, 2002, because we had 9/11. But if you had the sample set from 1933 to 2019, you're looking at all the different aspects. From the far left is if you had a Democrat-controlled Senate, Republican House, and a Democrat president, from all of those, that sample set, how have markets performed based upon the S&P 500 performance over that period of time when you had that combination? That's a 13.6% on the markets. That could happen. That could happen, quite frankly. But in reverse, we could see actually the Democrat House, we could see Democrat president, we could see Republicans control the Senate, and that's the next one here. What you see is the Republicans, Senate control, Democrat House, and Republican president. So historically speaking, you're at a 13.4% annualized rate of return on the S&P 500. Again, this is history, not projecting what's going forward, but historically speaking, it's been a good guide. And then if you have a Republican-controlled Congress and Democrat president, this is not going to happen this year and all the way through. So you have some probabilities here where you have a Republican-controlled Congress and Democrat. You can see sort of all the different annual performance. The good news is all of those that we're seeing are positive. I think the likely outcome we can see the far left, and we'll talk about that going forward too. This is interesting. The S&P 500 has predicted all the presidential election winners 87% of the times since 1928. So the S&P could be the best indicator of what we see going forward. So we're going to pay attention to the markets. The 3 months leading up to, so August 3rd is 3 months to November 3rd. We want to pay attention to how the market's going to perform over those 3 months, because they have correctly predicted all but a handful of times the winner. And the take-home point is if the market is up before the election, over the 3 months beforehand, for voters, people don't want to mess with a good thing, and they really vote the incumbent back in, versus if the market's down, it's really a referendum, and they basically say, you know what, let's try something new. But 87% of the time since 1928, it's a pretty good indicator. All but 3 times that's been a really good indicator. Question is, what could be a catalyst for the market sell-off between now and then? Time, additional layoffs. As I talked about, unemployment, that could be persistently stubborn. A second wave of this virus. Every day we get a vaccine headline to a shutdown headline from different states that aren't doing so well, unfortunately. Or if we don't get a vaccine at all, that could be not good. And time is sort of going to be our friend in this, but it's also going to lag on the markets if we don't have any positive improvements in some of those. The second thing is that policy waning over additional stimulus. I don't think that's going to happen. The question is not if, it's the timing of which and the size that really matters in this case. Number 3, return of corporate guidance. This is a big one. If corporations start guiding again, but they start giving you sort of negative outlook, as CEOs do, worst case scenario going forward, sort of manage expectations, corporations then can start, or the markets then can start valuing sort of the valuations, the PE matters at that time, the price to earnings ratio. It could be an upside surprise, so we could be pleasantly surprised, or it could be like, oh, markets are ahead of themselves and earnings aren't as best as we thought. So that's something, return to corporate guidance, we want to look at that. The fourth thing is policy error. I don't think this is going to be the case going forward, but if the Federal Reserve, I think they've been on point, they've been rapid in terms of their response, they've been course correcting, as case point is high yield spreads. We want to keep a look at the high yield spreads. They're sort of in a range right now. That's going to let us know in the investment world how to manage and position properly, because if corporate spreads or high yield spreads sort of start rising again, we call that blowing out relative to the treasuries. That's a concern of, we're going to see inflated on the VIX. We're going to see inflation or inflated numbers in terms of corporate credit and high yield. So that's sort of a red light on our dashboard. Right now, it's in check and well within lines, but that could be something that we continue to monitor. The Federal Reserve talks about negative interest rates, talk about policy error. Markets doesn't like that. And then finally, Democratic sweep in November, but markets are sort of coming to terms with that and positioning accordingly. But we can be positioning our portfolios. We did this in 2016. We both had what if scenarios for our clients in Blanke Schein Wealth Management, and we had many conversations with our clients, that there are sectors that win and sectors that lose depending upon, if it's red or blue. But there are sectors that actually do well, infrastructure spending as an example, that we could see bipartisan policy support regardless of who gets the White House. So we could see sort of rebuilding America theme play out. We expect that to play out going forward. So there are some positionings that we're going to make in the portfolios on a going forward basis, not to be too worried about them, who wins the White House. I think what markets worry most is that all one party controls, because that means that that party has control and they can spend as much as they want versus a check and balance. And I don't think it could be close. I don't think that's going to happen. I think markets are sort of up on the fact that there could be a Democrat in the White House, but Senate might sort of be the Republican control. Who knows how that plays out. The next 90 days to watch. I've talked about this in my daily updates. I'm the chairman of a private institution here, Xavier College Prep private school here on this school board. And we're talking about reopening. And across the United States, it's the reopening conversation. It becomes very difficult. And there's no easy answer and there's no right solution at this moment in time. And this is an evolving thing. What markets are paying attention to and what matters is schools to reopen is the key to the economy. Let me give an example. Over 40% of our families have a stay-at-home child under the age of 18. So that means that mom or dad can't go back to work, if even called back to work, or what childcare are going to be sort of, what options are there if they need to be called back to work? That's just taking the child out of an environment for school, putting them in childcare with other kids, so on and so forth. But ultimately, that means that's the worker back to working or the economy. Unfortunately, this has become a political hot topic. There are very sides that are digging in. I wish there was a solution, because my heart goes out to all of those that are out there, those that are on the front lines that are critically exposed to this virus, which is a real threat. But then there's inner cities and urban areas where there are over 15 million kids that literally are dependent upon breakfast and lunch, even dinner, for 3 square meals a day. And those kids, in the report by the school districts, just showed that over 2/3 in some districts, not even the kids don't even have the technology, let alone logging on. So if you really care, there's kids that are falling behind, and this is just a whole big unfortunate thing, not only for our educational system, truly tragic, I think, and that's going to be a hot topic to watch going forward. There's no easy and right answer, but schools reopening as it relates to getting people back to work and childcare. And that's going to be key for the economy. That's what markets are watching. There's another one. This is interesting. The third quarter GDP will be reported and released Thursday, October 29th. That's just days before the 2020 presidential election. So this slowing fits and starts of the economy reopening in the third quarter right now, that we're presently in, is very impactful to the markets. Very impactful to the market. So it's going to be reported in the third quarter GDP. a few days right before the presidential election. So we know we're going to have a positive snapback because the economy is reopening and people are going back to work and there's commerce actually happen again. We don't know what it's going to look like, but it's just interesting. We're noticing that. That's an important number that we have on our dashboard in the next 90 days because it relates to how we manage our clients' money as well as the 2020 election. I know we're over time, but stay with me. I'm almost finished. I appreciate your time. Caution, 2020 could be the year that all models have been wrong. This, I mean, medical, political, financial, everyone we've seen on television have been, that's why I went directly to you guys through my YouTube channel. I really want you to subscribe. We're going to continue to be committed to you guys to provide the daily updates, if not weekly updates for certain, as to what markets are paying attention to. Again, we get up at 4:30 in the morning, I do personally, and I really go through the markets and make sure that we have the right real-time relevant information that markets actually pay attention to and things that move the market. Because markets have seen through, as I keep talking about, the medical projections, worst case scenarios, the political projections, sort of who's going to win every single year. There's a projection, and 99% of the time they're always wrong anyway. Financial projections, economists have two hands, one hand this, one hand that. So this could be the year where all three have been consistently inconsistent or consistently wrong. That's my projection there. So I just be cautioned to what you're watching. If you're watching something and you believe in it and you have somebody telling you that's the case on sort of the channel you're turning into, be cautiously optimistic. Take it with a grain of salt and do your own research. That's what we're doing for you here as well, if you need that. China, the thing that matters most is actions versus rhetoric. I've reported about this several times. The most important thing is that the trade deal is still intact. No one has done anything to violate that. They've talked about doing it over weekends of time, and you show up Monday morning and China does the actual purchase of soybeans when they said they wouldn't, and they said the deal is off. So there's rhetoric and headlines. I think both have egos and trying to save face, politically speaking, from the United States and the White House, as well as China. And I think they're doing it for their own good. It makes them feel good. It makes it, pundit sort of politics, if you will. So the rhetoric is meaningless. Markets are paying attention to the actions, and I implore you to do the same. That's what matters. And then credit markets I discussed, that's really the key here. So thank you guys for watching today. There's a couple of things. If you want to get a PDF and a follow-up, again, go to our website or email Nayan and go through our website and we'll get it for you, or Nayan will get you a copy to share with friends and family. Again, like and subscribe. You can go to blankesheinwealthmanagement.com. And then our YouTube channel. If you enjoyed this time together, I appreciate it. If you want more of us, please do it. Rick Jr. is doing financial foundations, and those are fantastic updates. He just had a Rick Jr., William Blanke the sixth. And again, we're a family business, so we have 3 generations to serve you. So Rick Blanke the fifth and the fourth. They're all here and we're all working together. We thank you. We appreciate all the time today, and we look forward to seeing you. This could be our 100th broadcast. So special thanks to Nayan and all of her efforts, and we will see you guys again next time. Take care. Have a great day.